and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our 11th annual banking conference. Our next live presentation is from Victory Bancorp. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Joseph Major. He's the bank leader of Victory Bancorp, which trades in the OTCQX Best Market under the symbol VTYB. Welcome back, Joe.
Thank you very much, John, and thanks to everyone at your organization and to all of you who are online to watch this. We're here to talk about Victory Bancorp. Most of you know that it's a small bank holding company. Victory Bancorp has one asset, which is 100% of the shares of the Victory Bank, which was founded 17 years ago and operates in Limerick, Pennsylvania. We'll talk a little bit more about that. As we run through the slides, I want to give you some quick highlights, and this is as of year end. These are audited numbers. 28 cents a share, fourth quarter earnings. Book value is just under $15 a share now. We've seen the shareholder equity increase by about 1.4 million over the last 12 months. We also paid a quarterly dividend of 6.5 cents, so 26 cents annually. We saw a very significant increase in deposits since the end of 2023, about 33 million, and a 26.6 million increase in net loans. That's net of reserves since December 31st of 2023. That 26 cents a share, has been paying somewhere around 2.5%. And we also did a subordinated debt issuance in the fourth quarter in December of 2024. We issued 4.65 million of subordinated debt. And so far we've downstreamed about 2.5 million of that from the holding company down to the bank. I'm going to go through the pictures and introductions of our team very quickly. I want mostly to get across to you that we've been working on this project and we've had great stability since the beginning in 17 years that we've been operating. I'm still the largest individual shareholder, and I've been active in the trade organizations. I'm on the board of the Federal Home Loan Bank of Pittsburgh. I'm finishing, actually my first term ends this year. I would stand for re-election later on this year. Bob Schultz has been with us from the very beginning. He was our second employee. He's an accountant by background in trading, a CPA, served with other banks, 35 years in the industry. He's on the board of the PACB. He's been a trusted advisor, friend, and confidant from the start. Shelley has been with us almost that long, and Shelley is in charge of human resources and retail. She has a master's certificate from Villanova in HR, graduated from the PA Bankers Leadership Institute. She's chair of the Bank Healthcare Consortium and is heavily involved in SHRM as her expertise in HR has continued to grow. This is John Swear, our Chief Credit Officer. John joined us a number of years ago in 2013. He's really a black belt commercial banker by training, especially in the C&I area, and joined us when our existing longstanding Chief Credit Officer retired. John was promoted into that job, and he's done a terrific job for us. Next is Alex Kroll, who also has been with us for most of the last 17 years. He's our Chief Lending Officer. We had a Chief Lending Officer when we started, Mr. Richard Graver, who passed suddenly 3 years ago. It was a real tragedy, but we promoted Alex into the job, and he's got 37 years in the business. He's really done a terrific job. Note he's a Stonier graduate. That's where he and I met years and years ago. We were in the same class at Stonier back in the 90s. And this is Ben Major, who is my son. He's our Chief Information Officer, Director of Marketing, and also runs our ALCO models. He has a BS in Finance from IUP Honors College, where he graduated summa cum laude, and he has an MBA from Temple and also went to Stonier. He's doing a great job for us. This is our board of directors. I'm not going to go through in detail other than to tell you we have former county commissioners. We have Lori here is the chief of a well-known accounting firm here. All of these people are highly accomplished business people with the kind of background that we need at a bank like ours. All right, what about us? Well, We're not really a community bank, even though everybody calls us that. We are what you should describe us as, a specialized business bank. We're on the outskirts of Philadelphia. We do 85% of our business in Chester County, Montgomery County, and Berks County. Those three counties have a population of about 1.8 million. About 90% of our balance sheet is commercial loans. We do commercial real estate, and we're also a well-known local C&I lender. We also generate and sell a small number of residential mortgage loans, and we have a small portfolio, about $25 million of home equity lines of credit. That's what we specialize in. That's what we do well. And we do it well because our strategy says we need to have a superior workforce. We want the client experience to be better. And so everything we do here, and how we hire people, how we train, how we pay people, is about supporting the strategy of a superior workforce. We've been named a top workplace by the Philadelphia Inquirer for the last 3 years. We just found out this week that we won that award again. And we've been named the Reading Eagles Reader's Choice and Best Bank since 2021. What do you get when you bank with us? Well, it's high value added personal service and advice. We're very good at what we do. We believe that speed matters, meaning giving our clients quick answers. Even if that's a no, we try to operate at a high level of speed. The legal lending limit for the bank now is just over $7 million. And we do a lot of electronic delivery. 70 to 80% of all of our deposit inflow is electronic. Now, we still operate a traditional retail branch. It's an important place for clients to do business with us, to come to us when they have a problem, come to us, a place to close loans, and it creates a presence in the marketplace that you can't replicate in any other way. It makes it real for our clients. And we are continuing to build the talent level around here. If you hear one message from me, we believe that this is a bank like ours at our size, under $500 million, is a cultural phenomenon, and we can only be phenomenal by recruiting top-tier banking talent and training them and keeping our turnover low. So we are very heavy into investing into our team. We pay better than average. Our average salary and benefits for most positions are better than average, and that's intentional. We also spend a lot of money on training and internal training and promotions to foster growth within the bank. Some accomplishments today: we operate in suburban Philadelphia. We do a significant amount of lending actually in Philadelphia County, but deposit gathering has tended to be more Montgomery, Chester, and Berks. It is a tricky proposition, Philadelphia, just because of the scale and size of the city. We've shown very consistent growth in loans and deposits since we've operated. We grew net loans, you can see, about 7.3% year over year, and deposits we grew about 9% in what was a very, very tough market. One of our most important metrics is credit quality. If you look here, you can see non-performing assets at 0.05% at the end of the year. The peer average in the UBIPA reports we get from the FFIEC is 0.49, and we're at 0.05. So you can see that very, very strong credit quality, and it's been that way since we started the bank. We've done about $1.7 billion in loans since we opened, and we've charged off a total of about $2.5 million. You can see that I've listed it as competitive rates of return and quarterly cash dividends. Return on assets last year was only 54 basis points, and return on equity was down to 6.13. You know, we've been running quite a bit higher than that, between 90 and 100 basis points, but we really got squeezed on our margins. In particular, our cost of funding increased by something like 900% in a couple of years. So we saw an extremely rapid run up in funding costs. Part of that is because about 20% of our bank is funded by municipal deposits of all kinds. We have sewer authorities, we have townships, we have school districts, and so forth. And a lot of that's linked to the Pliget metrics in the state of Pennsylvania. And as Pliget goes up, those costs of those funds go up and down. So we have been whipsawed pretty hard by the increased cost of funding, as many small banks have. You can see that the returns are compressed, even though credit quality remains good, and our yield on the asset side is actually quite strong. because of those funding pressures and the cost of funding, we have decided to open a second retail branch. We've operated for 17 years with one retail location and this tremendous dependence on remote capture. But we believe that this is a terrific location for us. We have a loan office already there. We've had it for several years. And this is, if you're familiar with Montgomery County, it's 825,000 people. It's twice the population of the state of Alaska in Montgomery County alone. And we're way over in the western corner of the county, along the Route 422 corridor. This operation is on the complete other end of Montgomery County, still in the same county, but it's in some ways worlds apart. You get on the turnpike in Cross County, much closer to Lower Bucks County and Philadelphia County. It's located at 100 Gibraltar Road, which is right off a block off of Route 611, which is a main transportation corridor north and south, and a turnpike interchange about a mile away from this location. We are retrofitting what was an existing branch of another institution that was closed, and we are literally set to open in a matter of days. We're pretty excited about it. We think that this gives us another touchstone, a place where clients can see us, to know that we're for real. We're engaged with the Eastern Montgomery County Chamber of Commerce. Here's a map. And it's a little bit deceiving. If you look in the middle of the map, you see 1 and 2 right next to each other. Those buildings, that's actually our retail bank and then our corporate headquarters, which are about 100 feet from each other. Right next, they're buildings that are proximate to each other. And the same over here, 4 and 5, over in Horsham, where we are adding the second retail location. Our existing loan office, which is marked as 4, and this new retail branch marked as 5, are about 500 feet from each other. Finally, if you go in the far left of the map, up in the top left, you can see a location as number 3. We've had it up there for years, and that is a loan production office in Berks County. We don't gather deposits there at this time. It is strictly an LPO, but that's been a terrific market for us. We have 2 long-standing, experienced commercial bankers that work the Berks County market for us, and we have generated substantial growth in that market as a result. By the way, let me just jump in here and say, you could put your questions up, and I've got one from a shareholder, and he's written, if loan growth slows, would you consider buying back stock in 2025? And I think that the part of the question there is tied to the second question from the same interested party. Can you tell us your expectation on net loan growth for 2025 and how your margin fare if rates stay the same in 2025? Well, those are 3 big questions. Number 1, if loan growth slows, we would consider buying back stock, but I wouldn't promise it, because capital is king in our business, and our capital ratios, while they're fine as they are, they don't give us a lot of room for rapid growth. And we have grown the bank double digits almost, I guess, 15 out of the 17 years we've existed. And our pipelines are good. We continue to produce new business. And so I'm not counting on loan growth slowing down to the point where we would do that. Our budget number is 7% for growth this year, to answer the question. And margin's going to improve no matter if rates stay the same or not, because two trends are happening. We continue to reprice some of our existing commercial mortgages that were put on the books 4 and 5 years ago. Those mortgages are coming due, and a lot of them were booked at between 4 and 5%. And currently, a lot of those loans are being rebooked at 7% up to 7.5%. Secondly, we're seeing funding costs stabilize. We're seeing real improvement so far year to date. The funding costs are dropping rather consistently, and we expect them to improve. Thanks for the questions. I'm going to go to the slide marked performance metrics, and you can see the ROA that was as high as 1% in 22 dropped to 67 and then 54 basis points in 2024. And again, that's 100% margin compression. Look at the spread numbers. It went from 315 down to 237, and our net interest margin, 382, dropped to 318. Now, 318 is about 50th percentile on the comparison basis, but it's still much lower than we're used to operating. For many years, we've run the bank in the high threes or even the low fours when it comes to net interest margin. Efficiency ratio was 64 and rose up to 71 and then up to 78. That's not because we added much overhead. You'll see that that has all to do with reduction in revenue because of spread compression. And you can see a sense of what that means. We've continued to grow. You can see our loan to deposit ratio is still 86 to almost 100% at the end of 2024. Non-performing assets, these asset quality ratios speak volumes about our ability to manage credit quality. You can see non-performing assets have been de minimis. We had a little blip at the beginning of 2023, but we settled those deals and got paid off in full. We had no losses. Non-performing loans at 0.07. Our allowance to non-performing loans at almost 1,700%. Our allowance is about 92 basis points as we sit here right now. Our charge-offs were 0 in 2023 and 0.01 in 2024, exceptionally good. I'm going to show you some slides. We're going to go through them fast. I still have room for more questions. Bring them on if you can. You can see that we had like most banks, we had this strange run up in deposits during COVID. A lot of that was a lot of things, including PPP loans and other things that contributed to that. People just holding on to their cash. Deposits really ballooned all the way up to 394 million in 2021 and began to drop back down. You can see if you just drew a line, kind of straight line that up, that where we are right now shows consistent growth. If you look at loans, by contrast, that's been very consistent. That's balance sheet loans. That doesn't include 100 million plus of PPP loans that we put on and then that immediately or very shortly thereafter paid off. So that's a picture of our loan and deposit growth. Now we'll look at total assets, and the same thing applies. You can see during COVID in 20 and 21 how the total asset number jumped way up. And in particular, look at the cash numbers. You can see these blue bars in 20 and 21, and it shows us leaving a lot of cash around not invested. We were actually really conservative about that. Our investment portfolio did grow up to about 50 million. So it's a little more, than 10% of our balance sheet. But what we did not do is to go out long on the yield curve. And so we were able to keep our negative mark on our investment portfolio is about $2 million today. Still pretty small. We felt very like we made the right decisions to stay short and not go out on the yield curve and take a lot of interest rate risk, which we were glad we did. This shows a pie chart of the makeup of our deposits. This right up here, the dark, I didn't even know what color that is. It's almost a dark green. That represents non-interest bearing deposits, which are 14% of our total. You can see demand deposits here at 16%, MMD money markets at 28%, other conventional savings and premium savings at 13%. And time deposits less than 250,000 represents 21% of our balance sheet. So it's pretty diversified and typical for a small bank. We like that 14% number. We'd like to make it a little bigger. Total funding growth has the same blip in 2021. You can see, other than that, it's been moving up nicely. This is an interesting slide because it shows you a combination of loan growth and also loan charge-offs. You can see the loan growth back in 2019, we had 243 million of net loans, then 284, growing consistently. We ended the year just under 400 million last year. And one would expect our charge-offs to maybe rise kind of the same way, because this is a hard number here. There's your scale for charge-offs in thousands of dollars. And you can see that we had minimal charge-offs in 19 and 20, 21, basically zero, 22, almost zero, 23 and 24, almost zero. So we've been pretty lucky. Got another question that popped up, a good one from a shareholder. Do you have any exposure to downtown B and C office buildings? And the answer I would give you is virtually none. A lot of office building loans just tend to be kind of out of our league size-wise, and we don't go after them. We have a lot of mixed-use properties. We have some small office buildings, but none of them are the downtown kind of properties you're thinking of. And we do a lot of small buildings. We do a lot of owner-occupied real estate or mixed-use real estate. So the answer, I believe the answer is actually zero. But if it's not zero, it's nearly zero. Thank you for the question. I want to skip forward to looking at our net interest income growth. This is an important slide. You can see that in 14, then to 16, we had this really nice consistent growth of net interest income. And then with the wild increase, the 500 basis point rate shock that we went through in 23 and 24, even though our loans grew and our yield on loans continued to be exemplary, we ended up making less net interest income because our cost of funds went so high so fast. This gives you another picture of that. You can see the dark green bars are actually the consistent loan growth that we have shown. Again, balance sheet growth. These are not loans like PPP that we brought in and then came off the balance sheet. But this gives you a picture of our consistent practices here. But you can see the net interest income got crushed because of the cost of funding for those loans in the last couple of years. This shows our net interest margin compared to peer banks. This comes from the UBIPR report from the FFIEC. And we have mostly been well above peers when it comes to net interest margin. It's an interesting looking chart. We have a couple of times dropped even a tiny bit below peer, but most of the time we've been above peer. And why is that? Even though our cost of funds are so high, we end up with a really higher yield on loans. We're very disciplined about pricing at the Victory Bank. And so we don't give it away. We make sure we get paid for the risks that we take. I like this chart because it shows asset growth compared to employees. Employee scale is over here on the right, and you can see that we haven't added a lot of people. I think we might have 56 people today, but the asset growth is consistently higher. And we expect that over time, that's really going to give us some greater efficiencies and better return on equity for our shareholders. And this is another chart that shows the same thing, loan growth as compared to employees. And again, we might have 55 or 6 today. I don't know the exact number. I'm going to skip this chart. Chart is too complicated to explain, but this capital structure one I think is really important for you if you're considering buying our stock or own it now. This is the holding company, that's Victory Bancorp on the left, and then the actual bank that is owned by Victory Bancorp on the right. So if you start on the left, you can see our capital is made up of stock, original capital stock. We have retained earnings, which is the red bar that continues to grow as we accumulate more and more retained earnings. And then we have the subordinated debt, which are these large green bars. And you can see that we've used sub debt to grow the bank instead of using a lot of common equity, because the ability for us to go to the market and sell common equity without diluting our existing shareholders has been difficult the last couple of years. The market has not been very kind to small bank stocks, ours included. And so we've been trading well under our book value, that is our liquidation value, and we can't sell stock for anything close to it right now. We think that that's a tremendous upside opportunity for investors to buy into the stock at such a low value. And the up at the top, this gray bar represents our allowance. We are now fully course implemented with CECL, and our allowance has been pretty stable up here because our loan quality has been consistently excellent. If you skip, down here at the bottom, you can see the negative mark on the AOCI, accumulated other comprehensive income, that shows up as a negative. So we're about $2 million down on our investment portfolio, 2 million out of 50. If you look at these carefully with other financial institutions, I think you know that our 2 million is really a pittance as compared to what some of the other banks have run up because they invested very long in some low yielding assets. And we didn't do that, and so we have a pretty small mark. Same thing here. If you look at the bank standing alone without the sub debt, and this is just bank capital, which is up to about 48 million, we have the negative mark down here at the bottom. We have the actual equity stock, and then we have the retained earnings in red. So we continue to accumulate capital. We've got one more slide. Oh, I'm sorry. That was the last slide that showed anything substantive, but I'll put the logo back up. I've got another question here. The question comes, and this is I thank you for these questions. They're very helpful. What are your growth drivers for 2025? Well, a couple of things. We have not relied much on any kind of marketing. We believe in shoe leather marketing, meaning that we hire experienced commercial bankers who have centers of influence, contacts that they can call, and they do a terrific job. Once we seem to get a referral from one of these centers of influence and we do a nice job for the client and make the center of influence look good, we tend to get more and more referrals that come from the same source. So number one driver for us was and will continue to be the referrals we get from satisfied clients. This is an extraordinarily great place to work and a great place. What we deliver to our clients really stands out. But we have budgeted considerably more marketing this year because we're opening a second retail store. We also have hired additional business development people to work in the Horsham market alongside that new location. So for us, we're not making any flashy changes other than we're spending a little bit more in marketing. We're opening a second retail branch, which we already have a nice foothold in that market. I have another question I'd like to read for you. Are you anticipating any regulatory changes in 2025 and potential impact on your business? Well, okay, that's a loaded question if there's ever been one. What we hear, keep in mind that being a small bank, we've still managed to be really active in the state trade organizations. I was chairman of the PA Bankers 5 years ago. I was outgoing chair. Bob Schultz, our CFO, is on the board of the PACB, and I'm on the Home Loan Bank board in Pittsburgh. So I think we're pretty tuned in. And what we see so far is that we think that the changes in the regulations, not the regulations, but the regulators, the leaders of these regulatory bodies are going to be probably less invasive and more user-friendly. And I'm talking about the FDIC, the CFPB, those kinds of entities. We are a Fed member, and we're a Pennsylvania state charter, and we're a member of the Philadelphia Federal Reserve Bank. And so they are our primary federal regulator of our holding company and of the bank. And we also are examined every other time by, we're examined by the State Department of Banking, where we have our charter. I don't think for us, we're going to see anything monumental that will change how we do business. But I also think that maybe we, as an industry, may be under a little less pressure. And I think that's good. Another question, have we considered a stock dividend? And the answer to that is yes, we have. I have nothing to announce, but I will tell you that it's been brought up to me by more than one of our shareholders that they think a stock dividend is a good strategy for us. In part because stock dividends can sometimes give you a little bump in terms of your valuation without really, even though the mathematics doesn't support that bump, you still can get the bump. And I don't want to promise anything, but I will tell you that it is a matter that it was and is under active discussion at the bank. Okay, well, I've got about 2 minutes left. If there are any other questions, I'll sit and wait. I want to remind you that you can set up a private one-on-one session with us. There's a place to click on your screen, or there should be, and we'll allow you to do that. I want to thank you. I do think that our sector is grossly undervalued right now. People don't want to be in bank stocks, but we as an industry, I think we do a good job. And here at the Victory Bank, we're focused on excellent credit quality, strong relationships with our customers, knowing our markets and making the right loans to the right people in our markets so that we can generate a fair rate of return to you as an investor, right? Pay you a modest dividend, give you a good rate of return, and do that in a safe and sound way. I'm a big believer. I'm a big investor in this bank myself as the largest individual shareholder. And I think you can be assured that we will continue to operate that way as we have. Well, seeing that I have no further questions, I'm going to end our session, sign off with a thank you, and much appreciation from us here at the Victory Bank.